Hello, this is Beast McFeast here with the final video in the Investing Terms You Need to Know series. For this, we'll have covered 40 basic investing terms that every investor should know. They should help beginners to understand what they're reading online or watching in videos. So we're going to start this one off with fundamental analysis. This is probably what you think about when you think of researching stocks or whatever investment you're interested in. You're essentially attempting to estimate the value of a security through looking at things like the balance sheet, sources of income, and the security's place in the market that they're in. Sometimes this requires industry specific knowledge, so the comparisons you make, so the metrics you look at for your securities are going to be different depending on what industry they're in. So looking at, let's say, the price to earnings ratio, you wouldn't want to make comparisons between different industries because that wouldn't give you a very good idea of how well something is priced or how much they're earning. So some things you're going to have to look at when you're doing fundamental analysis. The balance sheet is pretty critical because it's going to tell you what assets and liabilities a company holds. Pretty straightforward. Now, where do you look to find these things? Every year, a company releases a 10K report. This is an indication of their financial performance. Your broker is probably going to give you access to these reports, or you can hop online and type in 10K and the name of the company you're interested in and probably get there. A 10Q is pretty similar to a 10K, except for it's the quarterly report. Now, an 8K is different from these ones because it has sort of miscellaneous data, except for the companies are following rules on like when to release an 8K. These are going to tell you major changes in the company that investors ought to know. Things like changes in CEO, or if the company is going into bankruptcy, the changes in voting rights for the shareholders, or if they acquire a large portion of another security or another security buys a large portion of them, you'll be notified via an 8K. So assets are going to be on the balance sheet. What is an asset? They're things that can make value. Talking machinery, land, and intellectual property most of the time. Assets are going to be accompanied with like a column or row on the balance sheet that is indicated as depreciation. That's the decline in value of an asset. It's a tax write-off for the company, and generally you view assets as having 10 years of depreciation time. So if you think about your car, you buy a new car and you drive it off the lot, and then let's say a year later, well, it's gone through some of the lifespan of a car, so it's gone down in value some amount. Same thing with a company with like heavy machinery. You'd anticipate that it's going to break and cost money to maintain, and that's going to be included in your depreciation. This is not income. Some companies will try to make it look that way on their balance sheet. It's not that. This is essentially them getting a tax write-off for things breaking, or the anticipation of things breaking if it doesn't break at that time but will later. Conversely, to assets, we have liabilities. These are your ongoing costs and obligations. Things like recurring payments for raw materials, salaries, benefits, long-term rent agreements, and debts. Technical analysis is sort of the other side of how you might try to evaluate whether or not you want to get into a company. It's abbreviated as TA everywhere, essentially. And it's essentially reading chart patterns and indicators for an idea of whether or not there's a good entry point or a time to purchase the security, or to tell you what direction the security is going to go in the near future. This is costly to learn. There's no way around that because you're going to make mistakes if you try to apply this. You'll see a lot of videos that tell you things like the 3-bar technique, where you read 3 candlesticks and then make a trade based off of what they did. Or some things that tell you to like use the MACD and RSI, and you're going to be able to make consistently profitable trades. It's not really true. There's a lot more that goes into it. And most people who use technical analysis are going to run into pretty heavy costs if they use this alone. Paired with fundamental analysis, you're more likely to do well. If you know the direction of a company, technical analysis can help you find a good entry point or a good time to initiate purchase of that security. Using technical analysis alone, I would not do that. It takes a high degree of skill to use effectively. There is a lot of discussion about whether or not technical analysis is anything beyond trying to read a crystal ball, and most people aren't going to do better than chance on this, at least until they're well educated in it. And that can take years and tens of thousands of dollars to get there. Moving away from the analyses, we have two types of accounts we're going to discuss today. One is your traditional individual retirement account, IRA. What you can deposit into an IRA is money that you do not pay taxes on. More accurately, you deduct what you put into your IRA from your taxes. Because you didn't pay taxes on these dollars, you will pay taxes when you withdraw this money. So ideally, you would be putting money in while you're working to reduce your tax basis. Then, when you stop working and your income is lower, you can withdraw at a lower tax rate. Within an IRA, you can trade in a similar way as you would a regular investment account, a non-margin enabled investment account. So you're not going to be able to go into debt in an IRA. Now, the Roth IRA, a lot of people love Roth IRAs, and they're right. What you're putting into a Roth IRA is money that you do pay tax on. So that's not great because you've been taxed before you put your money in. I get it. Nobody likes to do that. But you don't get taxed on the gains or the withdrawals from this as long as you meet certain criteria. The criteria being your age, and how long the money's been in the account. Deposits that you make into this are going to be limited by your age and income. So if you're making too much money, I think it's something like $130,000 for an individual, you can't put money into an IRA or Roth IRA. You're going to want to look up what the current cap is on income for depositing into a Roth IRA. It changes every so often, so I'm not going to give you a hard number right now, because 6 months or a year from now, it could be a very different number. What I will tell you is there is a way around the inability to use a Roth IRA. There is a way around the maximum income when you want to deposit into a Roth IRA. It's a backdoor Roth IRA. You can look up how to accomplish this. It involves going through a traditional IRA and then switching that money over into a Roth IRA. It's a legal way to do this, but you're going to pay taxes on that money beforehand. And you might say, well, why would I want to do that? Well, the gains in a Roth IRA are not taxed. So if you have just an excellent run in the market, like you're in an amazing bull market, and in 10 years your Roth IRA goes up 300%, well, you're not going to be taxed on that gain. So there's no capital gains tax there. Great, it's incredible. And if you're getting dividends along the way, you're getting dividends at a high rate, that can, for a lot of people, push them up into a higher tax bracket. If the money from a Roth IRA won't be taxed. So in combination with your IRA, can make for a very comfortable retirement. Margin. So most brokers are going to offer a margin account. I think Robinhood charges to do this, but I think they're the only ones that I can think of that actually charges an account to just have that option. What margin is it is a line of credit within your investing account. And it allows you to buy more than you normally would be able to with your line of credit. For that line of credit, the broker wants to get something out of it, so they're obviously going to charge you an interest rate. The APR is somewhat high. It's pretty high, actually. Usually in the 8 to 10% range. But let's say you just get in and out of a trade really fast, like in the same day. Margin's not going to affect you because the margin hits at night. Let's say that you use $3,000 of margin and you hold on to whatever you bought overnight. Well, you're going to get a very small interest rate on that overnight. Now, it'd be bad if you held it over a year. And these charges can add up. They're not too terrible generally. I try to avoid using it in case something goes really wrong, because margin does put you at risk of debt. Let's say you leverage your account with a whole bunch of options and they go to 0 in value, and you had bought them on margin. Well, now you owe that money that you went into debt for. So your broker can call you up and demand that you pay them back. Leverage is getting more market exposure than you would normally be able to with typical means like shares. So when you're buying shares, you're sort of limited to how many shares you can buy. One way to get leverage is margin, where it allows you to buy more shares. Another way would be options, where you can buy short-term contracts to sort of give you more market exposure than you would normally have. Leverage often increases the sensitivity of your account to smaller moves in the market. It can be positive or negative. You want to learn to use this responsibly. You don't need to be afraid of it, but you should be cautious of it. And maybe when you first start trading, don't play with it too much. Options are derivative contracts, and they confer certain privileges to the buyers and responsibilities to the sellers of these contracts. So you can go and buy an option or sell an option. Some things you need to know right now is they expire. So they're time limited. They don't go on forever. And they can be very flexible. They can allow you to profit in various market conditions that you wouldn't normally be able to with just shares, even buying shares or going short on shares. These can be used to speculate using a high amount of leverage, or they can allow you to protect your account. And we'll get into that more when we get to an options video, which is going to be the next video after this. Options can provide you leverage if you want to speculate on the direction of a trade, or they can provide you protection if you want to take the other side of a trade. So let's say you go long and you buy a bunch of shares, you can buy an option to help protect you if that underlying goes down. And we're going to get more into this in the next video, which is going to be on terms frequently used in trading options. Thank you for watching. Feel free to hit that like and subscribe button, and go ahead and ask any questions you have in the comments. We're going to get into options next, and later I'll do some demonstrations on how to actually go about buying an option and what to look for when you're buying an option. Bye!